Next up, we'll be having join us is George C. George C. George C. from Annandale Capital, founder and executive chairman. George, you out there?
I am. Hi, Ed. How are you doing today?
Guy, I'm so good. I can't complain. Obviously, I'm having a Bitcoin slash. I don't know. I guess I'm losing my role when it comes to a value investor. I used to be. I guess I'm a little bit more excited than I should be. Which you, as quote unquote, the steward of client money, would understand how people get excited and get a little weird about stuff like this when they see those types of returns. So
absolutely. They say the old cliche is the market can stay irrational a lot longer than you can stay solvent. So anybody who wants to bet against Bitcoin with some kind of derivative or other contract that bets it's going to decline, I wish them luck. I'm not going to be joining them.
Well, we had one client on guest on once, and his response to that scenario was, "It's a trend till it's not a trend," and that's just something that you have to keep in mind when you think about securities in general. Having spent the amount of time I have trading, it's always interesting to watch these things in real time. For me, the first thing I saw happen this way, and this is weird, so I'm laughing when I say this, was Starbucks. I remember when Starbucks went public, and I just didn't get it. I remember asking myself, how do people pay $5 for a cup of coffee? Obviously, I didn't get it, and I was somewhat of a, I guess, kind of a Neanderthal when it came to understanding what was a paradigm shift in social activity. So let's kind of get to it here. Talk to us a little bit about, you're a busy guy. Obviously, you have a tremendous track record from an investment standpoint. How do you see global economics and investments in today's world?
Well, I would go back to your trend comment before I touch on that question and say I think too many people get their ego or their certainty of being right in the way of fighting a trend, and they decide they're going to be bigger than the market and they're going to make the right decision because they're quote unquote right, and people get carried out that way. It's never wise to fight a trend. You ought to just step back and get out of the way if you're not riding it already. So, global economics, global finance. We're about to have some extremely positive new data points in place if the Congress, which would be a miracle for them, they've been so inept for so long, can actually pass this tax reform bill. That's going to be a huge turbocharge for American business, commercial, economic growth. So we could see our growth rate go from low 2s to maybe as high as 3. And the rest of the world seems to be growing quite well, too. And commodity prices and other factors still are staying fairly low in terms of where they've been in the last 10 years on average. So there's so many tailwinds for global growth. And I think you can be bearish on what price you have to pay for risk assets today or even risk-free assets, because treasuries are so expensive from a yield standpoint. But I don't think you can really be bearish outside of a gigantic global conflagration or upsetting event in terms of economic growth and where the global economy is going. It's just really well positioned right now.
Now, you mentioned bonds and treasuries being relatively expensive. Would you say they're expensive with regard to opportunity costs for other opportunities that are out there, or is it just the fact that it's literally paying you nothing?
I mean, the price you have to pay for the yields you get.
Right.
The yields you're getting today is just so terrible, whether you're buying a 30-year or a 30-day piece of paper. It's just hard to stomach. I would say, though, that you mentioned opportunity costs. I think that the one good argument for risk-free securities right now or cash is the option value. That if you've got that money parked in something you can get it out of very quickly and efficiently and invest in something when you see a good opportunity, there's an awful lot of embedded value there, more so now than I would say in years past when prices were a lot cheaper and you were being paid to be invested. So I think that some people would be prudent right now to hold some cash or some risk-free securities if they can access it quickly to put it to work when they do see something attractive, because there's very few things attractive out there right now, and you want some dry powder to, while you survey the horizon and try to find something you want to put money to work in.
Well, you mentioned dry powder, and there's a tremendous amount of dry powder that exists right now in the private equity world, which is an area you operate in too, and along with me. The one thing I'm seeing from clients that we've talked to is that they're interested in buying businesses with significant cash flow in lieu of getting back into the market to the extent they might have been in the past. When you look at the amount of dry powder in private equity and the prices and the multiples that are being driven up to, how do you reconcile some of those prices going forward?
Well, you have to say that the private markets, people like to differentiate between illiquid private investments and public market investments. And the reality is equity, right? I mean, your public market equities are going to get a higher price because they provide liquidity and provide access, and typically those are stronger businesses anyway, so you got more margin of safety in terms of going concern risk through that. But the reality is the private markets are equity too, and their prices are going to be a derivative of what the public market prices are, and they're going to be less expensive because they don't have the liquidity and you can't trade in and out easily. But the prices in the private markets today, as opposed to what they were 6, 7, 8 years ago, are significantly higher. There's very few bargains out there, and people are playing the relative valuation and relative attractiveness game to try to raise additional capital to put to work in private equity. But the reality is, unless you're buying a really terrible business, you're not going to be able to buy a company at 4 to 6 times EBITDA and then flip it in a couple of years at 12 times EBITDA. That trade's over and done and not out there anymore. And so you're going to have organic growth and build a business and hope somebody will pay you a price higher than what you pay for it, or at least equivalent if you've grown the business in the years to come. I'm not bearish about private equity, but I think caution at a minimum is in order. And I think there's going to be lots of opportunities for people to lose money the next 5 to 8 years in private equity if they make foolish decisions or deploy capital haphazardly or rashly.
Well, I agree with that. On the next side of this particular break, we'll come back and we'll talk about the public side since we just talked about the private side. So you're listening to CEO Money with Ed Baxter sitting in for Michael Yorber. Be right back in a second. Welcome back to CEO Money. I'm Ed Baxter sitting in for Michael Yorba. We're talking to George Seay, founder and executive chairman of Annandale Capital. George, you brought up some really interesting things in that last section that were just really poignant to me. And I'm going to kind of go off the rails here for a minute because you're an intelligent guy, and I think I need your opinion on this. But you talked about private equity, and we'll talk about hedge funds. We'll talk about other different forms of investment outside of the public market. There's been a tremendous amount of capital raised in the hedge fund industry, and there are some mind-boggling valuations where some of those companies are putting money into. I guess the question for you would be, based on the fact that some of those companies are choosing not to go public because they're not getting a higher multiple in public markets, are some of those VC firms and hedge funds a little reckless?
In terms of holding on to those companies that are not going public?
Reckless as in, obviously holding on to the companies maybe longer than they should, or maybe they overvalue them in the private market to the extent that they can't liquidate them either by acquisition or by public offering.
Yeah, I think that's a time-honored tradition. I mean, if you go from East India trading companies to tulips to the internet, everything else, we consistently overvalue things, not just in the public markets, but in the private markets too. And I think there's a real, as we've seen, the number of firms that are public has dropped considerably the last 20 years, and there are significant companies that remain private, and that is something that we really haven't seen in the past. It was always an indicator of you've arrived and you're successful if your firm is public, and you wanted to take it on the New York Stock Exchange or the NASDAQ or the MX if you were a technology company or something that's not quite as big or substantial. And today, owners have decided, I don't want to deal with 10Qs, 10Ks, the SEC, every other form of government regulatory body, and 25-year-old analysts asking me obnoxious questions to try to impress their investors and their bosses. I don't want to deal with all that stuff. I'd rather stay private and have the reinvestment of my firm capital not based on a quarter, but based on a 10-year cycle, and I can do it how I want to, at the pace I want to, and I don't have to answer to anybody. And I think that's become very, very attractive for an awful lot of people, and I'm not sure that trend's going to reverse. I think it may stay pretty consistent. Now, obviously, there's some companies like Uber and some of the others that are burning cash at a ridiculous rate, and they're going to need the public markets to access capital once they exhaust private investors on the private side that are willing to provide them capital. So going public for firms like that does make some sense. But for some other companies that are free cash flow positive and growing well, they have to really think hard about whether they want to be a public market company. And I want to come back to private sector valuation as well.
Okay.
And here's where I think we really run into trouble the next 5 to 8 years. My understanding, and I may be a little bit off, but that in recent years, $1 trillion plus of private equity capital has been raised. Maybe it's since the Great Recession. Maybe it's a shorter period of time than that, but it's not over a decade. It's over a 5 to 8 year period or such.
Right.
And that only about $150 billion of that has been deployed so far. So you got a ridiculous amount of remaining capital to be called that could be put to work in different investments, and they're all competing with other firms to get this deployed. And so people just pay higher prices until there's less capital. You've got a classic supply-demand imbalance. You got too much money chasing too little supply.
and too few good deals. As a steward of client money and a fiduciary, how do you manage that when you're talking to clients and they're seeing things like an Uber or WeWork or Lime Bike, which started in May of this year, $275 million market cap, and all they do is rent bikes. I mean, to me, that's getting a little crazy. But as a fiduciary, how do you communicate to those clients that this may not be the best choice for them?
Yeah, that's a great question. I think that there's not enough fiduciaries out there that are legally obligated to be fiduciaries in the money management business. I'm one by choice. I've been one for a really, really long time, and it's the right seat to occupy in the business. And you have the highest level of trust and responsibility for your client's capital. And that doesn't mean that every client that loses money in a year or two should sue you unless you've done something negligent or grossly negligent or even malfeasance, something really you've done something bad. But the issue is that you've just got to be really, really careful about protecting your client's money and giving them an absolute return in every kind of market cycle you possibly can. But what I do is just have an honest conversation with people I invest for and say, look, I think that the equity markets the next 5 to 8 years are going to give you about a -3 to a +7, somewhere in that range. And I think fixed income is going to give you somewhere between 1 and 3.5%, both numbers pre-inflation being deducted from the return. And that's not very attractive.
No, it's not.
And you just better be ready to have some rough years. But, at the end of the day, if we make 4% in the equity markets the next 6, 7 years, that's a lot better than sitting on cash earning 0%, And if you're a long-term investor, you're just going to have to accept lower returns for a while. And that doesn't mean as well that you're going to get 4% every year. You might have an up 15% next year and then a down 25% the year after that, and then up 10 and up 5 and flat. I mean, it's just so volatile. And people have to be prepared for that and just learn to accept that you're not going to make 15% a year the next 5 to 10 years. There's just no way. The math just doesn't work over the long term. So then that puts the burden on someone like me or someone who directs their own funds to find private investments that are attractive enough to warrant capital outside of that money put in public stocks and bonds to work, because you're going to try to amp up your returns from maybe 2 to 6% across your whole portfolio up to maybe a 5 to 9% range. And the only way you're going to do that is private markets.
Exactly. George, we'll have to cut it short here, so we got to go to the markets to watch with David Williams. But
can I make one more comment, Ed, before we cut? I was going to say that basically deploying the money into the privates like that, it's been a lot rougher because we've made the case that those prices are higher. So it's just a tough environment.
This is true. George, thank you again for joining us. I appreciate all your time. So